Welcome back. Episode 72. Feels like it's been a while since I've been in the driver's seat over here.
There's a reason for that.
Cool. We got Keith, Kyle, Lisa, myself, all back, ready to go. Are we doing a podcast next week with EAF?
Yeah, we'll try to get it.
Explain a little bit what EAF is, Tyler.
EAF is our Elite Advisor Forum. We bring in our top 90 to 100 advisors, and it's really not a commercial for Gradient at all. We bring in outside speakers to give market updates, practice management, some motivational stuff in there. So I think this year we've got a really interesting lineup. Some of my favorites: Lizanne Saunders, Brian Belsky, Jeff Sherman.
Motivational speakers always good.
Yeah,
should be exciting for that.
Navy SEALs get you fired up for the rest of the week. So yeah, it'll be fun. But it's just a good time, get to network with a lot of our advisors, and obviously our top 100-ish typically come. So it'll be a good week.
Yeah, it's good for us and good for our advisors that they can network. A lot of our advisor base are, solo person operations. So it's nice to be able to mingle with their cohorts and kind of see what's working for them and what's not, and if they can get some tips. So it's a good event. Yeah.
All right, let's jump into it. 2 Truths and a Lie, Apple edition. Apple just had their annual iPhone release event. I'm a big watcher of that.
Maybe the only one left, I think.
It was a little bit disappointing yesterday. Just to give a quick recap, they didn't talk much about their Apple Intelligence. I think they're avoiding it a little bit. So we'll see. But yeah, so in honor of Apple's event, we'll do a 2 Truths and a Lie about Apple. So the I in iPhone was originally meant to stand for intelligence. The original Apple logo featured Isaac Newton sitting under an apple tree. And Apple briefly launched a digital camera in the 1990s called the Quick Take.
Wow, these are good, Tyler. Nice work.
Keith, what do we think?
I'm going. This one you got. It's a good one. I'm gonna say that the one that's not true is B, the original Apple logo, Isaac Newton under a tree. It just seems like a lot of stuff going on for a logo.
Kyle?
That's what I'm going with.
Fairly confident A is correct. I'm leaning towards B is not, because it just does seem like an awful lot going on, but Quick Take seems like a terrible, terrible name. So I'd be surprised if they would go with a name like that for a product. Maybe that was
the 90s.
It was the 90s.
Just saying.
I'm gonna go with C, because
the Facebook.
Yeah, we were like lemmings last week, and we all got it wrong. So I'm gonna split the difference and go with C.
There you go. Okay.
Because my questioning is so good. No, joke.
Wow. Lisa's gonna throw her arm up, patting herself on the back.
I don't know. It seems like it's 2 lies and the truth, to be honest. Because like the I in iPhone intelligence, I don't. The original Apple logo with the Isaac Newton apple tree. I'm with Keith. There's a lot going on for a logo. I cannot recall anything like that. And the digital camera, I can see that the name is weird, but I can see that they launched a digital camera. I go with B as well.
Got all of you. It is A.
Oh, is it really?
Yeah.
Dang it.
The I was meant to stand for internet.
Okay.
Was it really?
Internet.
I thought it's not intelligence, but I was like, well, the first logo is really Isaac Newton.
I have to pull that up.
Yeah.
Right.
Fact check.
Yeah, that's a deep fact check.
All right. So hot button. So we're kind of back in this scenario of bad news is good news again. Last week we got the jobs report. We only added 22,000 jobs versus 73,000 expected. Unemployment rate ticked up to 4.3 from 4.2. A little bit of that was participation rate jumped up from, was it like 62.3 to 62.4 or something. So that could have been a little bit of it, but after the report came out, market actually jumped higher, interest rates moved lower. So what are you guys' thoughts on this? Like, are we in this bad news is good news again? So if the economy is weakening, that means good thing for the stock market? Keith?
Yeah, unfortunately, I don't like this part of the cycle. Generally, when bad news is good news, it's okay. Really, how bad is good, and then when is it good is good. Yeah, it seems like that. Everybody's looking for a cut. The only problem is when bad news is good news. At some point in time, bad news becomes bad news, right?
Mhm.
It just how there's like a fine line of how soft you want it to be, right? It's kind of the soft landing scenario. I think is what ultimate question is. Okay, if we have less jobs, which we've been talking about unemployment going up to that, mid to upper fours. I think we're
Yeah.
still fine. Inflation seems to be coming down. So if they Fed cut, I mean, there was a number out this morning on PPI that was a little bit softer, and I've heard some people calling now for a 50 basis point cut. So
That's
it's
what I was
like,
going to bring up.
yeah, so it's like, okay, now we've gone from 25 to 50. In my mind, I'd rather do just 25 just because I'm fine with the soft landing. Also, oh boy, maybe things are a lot worse. And also, you have to do 50 basis points cuts. It starts a question of what the economy is doing, and ultimately, I think we've always talked about is earnings the ultimate driver of the overall stock market. So then, if the softness there, we may be seeing company softness, which earnings would start slowing down, which I think is ultimately a negative. So
Mhm.
there's a balancing act.
Yeah. So the interest rate cut thing, right? The Fed is now expected to cut. There's like a 68% chance that the Fed will do 3 interest rate cuts this year. So 0.75% by the end of the year. And then, yeah, there's people today, Mohamed Alarian on CNBC calling, or not calling, but saying that the Fed should seriously consider a 50 basis point cut like they did last year to kind of kick off the rate cutting cycle. So, Kyle, what do you think? So going off of what Keith said, probably not a 50, but do you think the Fed should pause, cut? Do you think they should cut 25 for the next 3 meetings? Is 50 on the table?
Yeah, that's a good question. Probably outside my pay grade. I think for yeah, I mean the markets are moving based off of expectations, right? What the market participants are, people don't like the unknown or uncertainty. So I think telegraphing a very clear, crisp message and following that is going to be pretty critical. I mean the market right now is pricing in concurrent cuts through the end of the year, and then at each meeting, and then a quarterly cut thereafter through next year. So I think that is probably the path that is laid out and should be followed. Whether it's 50 or 25, I don't know what is the right one. But it does make me think, is going back to the earnings commentary. I read been reading about small and mid cap companies, and we've talked about them over the last couple months. And some of the zombie companies, as rates climbed, the profitability levels and earnings have been negative for quite a few years now. And if you do see cuts, the benefit to some of these companies, and that bad news is good news, is an interesting dynamic, because these companies with floating rate debt, the figure I saw was every 100 basis points cut in the Fed funds rate translates to about 5 to 10% of EPS growth, or like a swing for these companies with large amounts of floating rate. So if you look at the distribution of that, it's small and mid cap companies overwhelmingly. So it does make me wonder, like, what is exactly priced in. And if you do see a 50 basis point cut, I would imagine small caps are going to rally really hard. I mean, just in the last month, since we've seen some of the inflation and labor data and some of the economics data where this is becoming crystallized, you look at the poly market expectations, small caps have really run a lot in the last month. I think they're up 8, 9, 10%, something like that, versus the market, is half that. So
do you think that this is not so much, we hear a lot about the meme stock rally. You don't, so even though a lot of these companies are not profitable, do you think that they're outside of the meme stock realm right now based on the expectations of the Fed, or do you think there's still a little bit of a combo of like, interest rate it's coming down and meme stock-ish rally for the non-profitable small
Yeah,
caps.
I think the meme stock one is a weird subset. I mean, they're you can name them, on your fingers. Like there's a couple that are readily identifiable. Others that fit the basket, if you look at the Russell 2000, I mean, out of that group, if you can name a dozen meme stocks, I mean, there's still 1,988 left. And most of them are over the last year and a half, 2 years have been unprofitable in terms of earnings. A good chunk of them. So I think there's value to be had. If you do see a bigger rate cut, I think it's going to be unexpected. I mean, you look at the poly market and expectations on the street, and the higher rate cut is moving up for sure, but I don't think it's necessarily fully priced in, and I think opportunities are definitely going to be there. I mean,
yeah. So Lisa, I'm going to throw you for a loop because I didn't put this question in the doc. When does bad news become bad news again?
Yeah, first of all, I think it's a little bit counterintuitive, and for investors maybe a little bit confusing that we got like a bad job report last week. That was certainly a negative, and then we had like the annual revisions coming in until March this year, which were also revised, the largest since 2009, so also bad, right? But the market is up, right, and reacted positive to it. And sometimes it's like for investors, what the hell does that mean, right?
Yeah.
Because usually a weakening job market is bad for companies, right? Now it is okay. If we have a bad job market, or a bad weakening job market, that means the Fed will lower interest rates, which then is seen as positive, as loans are getting cheaper for companies, and then it gets a little bit easier. But still, it's very confusing sometimes because it's not just the data, if it's good or bad. It's like in conjunction with so much else, right? And I mean, the two main debts from the Fed is kind of neutral interest rates, which we are not there yet. So that is still elevated with full employment. But still, it's like, I think the composition, how it plays together, and how the market is seeing it. And at the moment, it is what it is. I think we will next week, when we got a decision, we are back in dissecting every single word of Jay Powell's speech after it, in gathering some more information about that. But yeah, I think for now the focus has turned to the labor market more so than to inflation. But I think that's still not resolved yet. Again, we're still elevated. We still have the overhang of tariffs, which we do not know fully the impacts yet, even though it's subdued so far.
Yeah.
But still, it's a tough spot, definitely. I mean, if if inflation would be lower, that would be an easy call, right? But in this case, it's a tough spot to be in to make a decision.
So let's go there. So we got some wholesale prices this morning, came in weaker than expected, which is a good thing, right? Meaning prices aren't going up as dramatically as
they're actually down a little bit, right?
Yeah. So you're not seeing the full effect. And I think it's hard to tell like where the tariff pricing is going, like who's eating that cost right now. Because obviously companies are still reporting strong quarters. Wholesale inflation's down. CPI is creeping up, but it's not too dramatic. So I guess the question is always where is it, right? But we get CPI tomorrow. So, and I'll throw this out for anybody. If CPI comes in hotter than expected, so we're expecting 2.9% on headline, 3.1% on core. If it comes in hotter than expected, does that change the Fed's decision next week at the Fed meeting?
I don't think it does, unless it's dramatically hotter. I think if it's, couple tenths more, I think it's just whistling by the graveyard. I think everybody, this is maybe oversimplification, but I feel like, yesterday we had that million job revision down, and, Lisa noted biggest since financial crisis. People didn't care. And the reason they didn't care is because all eyes are on the Fed. Like, there's only a few major levers that are being used right now that are that are driving these things, and it seems like it's interest rates, so Fed, it's tariffs, and that's about and AI. Those are like the three things. That's it. On the margin, other stuff matters, and long-term investors, fundamentals matter a lot. So I don't think that a little bit hotter inflation is going to really make a difference. I think if you start seeing the commentary around labor continue to actually weaken, because the numbers yesterday were for, a year ago, which important still, and it frames the context of kind of what environment we're in now. But I think if you see current conditions of labor start materially weakening, that's going to be when bad news becomes bad news.
Okay.
Is what I believe. Because then, if you're in this rate cutting cycle, and then let's say over the next 3 to 6 months, you knock out, I don't know what I don't have the numbers in front of me, but let's say you knock out 150 to 200 basis points of effective rate. How much more are you going to go down? You go down to zero again. You're kind of the dry powder is gone. So then what are you doing? You're getting more exotic, like depending on how bad it gets. Are you doing Operation Twist? Are you doing QE? Like what are you doing? So I think at that point people become a little more fearful, and I think you see a problem.
So if inflation, so let's say so Fed cuts September, no matter what, right? If inflation comes in a few tenths of a basis point higher, it is what it is. But if you see this persistent inflation through October, November, December, does the Fed look at that as a one-time tariff bump and will normalize inflation after that? And they keep this rate cutting cycle going for the rest of the year? Or do they put on pause any potential rate cuts in October, December?
Well, yeah, the Fed's got a dual mandate, right? Full employment and stable pricing, which is inflation. Right now, I think the focus is on what Kyle said, is on jobs more so than inflation. So I think it's, a done deal. They're doing 25 basis points. Now, if the CPI comes in lighter, I could see that 50 that people are calling for. Then they say, okay, jobs are in, it's 50, and then let's get things going. And then it's going to be data dependent on, like I said, the messaging be important for the market. But I think they'll shift that focus from Paul basically pivoted at Jackson Hole from being more of a hawkish stance to more of a neutral to / dovish. And I think it's going to be dovish going forward, which then that means 2-3 rate cuts. And then the market will care about the pacing of it and kind of how it looks and job market. Again, I'm a little nervous that we do 50 and then jobs keep getting worse. And then all of a sudden that's when bad news becomes bad news. I think it's the labor market. So they're trying to get ahead of it, and the revisions aren't helping. It's then your confidence level. But right now the markets are kind of like saying everything's all good because rates are coming down. We are softening, but we're not crashing. I think that's the difference of, I don't think we're at to do any of these. We're at 425, I think, is where the Fed funds. So I think we have room to cut a couple hundred basis points and wouldn't even bother. That
it's not like we're losing jobs,
right?
No, we're just not adding.
We're just not adding as many. 22,000, I think, is the last month, and the revisions down. I think, but the company's earnings, right? They're pretty positive, and you didn't hear much about layoffs. You heard some, and we've been hearing for a year, though, consumer softening. So that's not a surprise. It wasn't, I don't think it was any more last quarter than the previous quarter that, we had JP Morgan, Jamie Dimon came out the other day and said consumers are on the edge, but he's been calling for the rain cloud for 2+ years.
But I think he's more so referring to those lower income, right? Because you get banks like Wells Fargo, Bank of America, they've all come out and said all good, right? So it's a little bit of an interesting twist.
Yeah. I mean, if you look at like that, just the consumer in general, like delinquency rates across like credit cards, auto, home, all that stuff, they're high.
Yeah.
I mean, 90-day delinquencies across the board are higher in most instances than during the financial crisis, which
no one's really paying attention.
No one's talking about, which And so you look at some of the like lower end consumer plays like Dollar Tree, Dollar General, and read through the earnings calls, and it's like they've been talking for a couple of years how those customers are really pinched, and now you're starting to see 2 quarters ago for Dollar General, they were the reason the stock has ripped since then, since May, is effectively because you're starting to see finally the upper end consumer, the $100,000 income per year plus, start to actually bleed down from a Walmart, from a Target into the Dollar General.
Yeah.
And so you're getting, kind of that bad news is good news in that dynamic where you're expanding the kind of TAM.
Yeah.
So, yeah, it is interesting.
Could this also be, so in investing, you always hear about don't fight the Fed, right? Regardless of bad news is bad news, good news is bad news, whatever the scenario. But you always hear about don't fight the Fed. And if the Fed's cutting rates, it's risk assets, and stocks are risk assets. Could that be part of what you're seeing too? Is you're starting this rate cutting cycle again, and so might as well just pile into risk assets because we don't want to fight what the Fed's doing?
100%. That's what's driving. If the Fed were to start saying, "Oh no, we're neutral to raising rates," I expect the market to give up some of those recent gains it's had. So I definitely think that's the mantra right now. And again, the earnings aren't falling, and the earnings expectations for this year are 10%, next year at 13%. I mean, so it's not like we're in this horrible thing where all of a sudden earnings are collapsing, unemployment spiking, where all of a sudden you have to cut 50-50-50 type of deal. We're not there. So that's why you got some people calling this is, the golden age of investing and great time to be in the stock market because of these tailwinds. If you get the soft landing and then you get the market broadening out, you get these small cap, mid caps participating. You've seen these AI numbers with Oracle last night. It's just unbelievable. I think that, pre-market, the stock's up 35% on a big cap name. So AI, Kyle touched on it. That's a huge driver, and it continues to be. And those are the big guys winning. And then on top of that, you start layering rates coming down that the small and mid cap companies can start participating as well. And that's why the market's doing what it's doing.
Well, I think too, just from the portfolios that I run, you look at Contrarian, and it's like the rate sensitivity of some of those small cap names. It's really unbelievable. It's powerful. I mean, Builders First Source, anything touching home building or construction infrastructure, Eagle Materials, you look at cement, those names, when they're talking about crystallizing a rate cut, they're up 4, 5, 6, 7% in a day. It's really surprising.
Yeah.
And it doesn't take a whole lot of money to be shifting maybe out of some of these mega cap names to some of these midish names. And it's easy to see those moves.
But it's also hard to get out of those names because
100%.
I mean, take Oracle, right? I mean, they see their revenue growth going 77% next year to what, 18 billion, and then they said they see a path to 144 billion. Like that's a pretty
crazy
significant jump. So it's hard. I mean, I get the idea of getting into these beaten down small cap names that have the interest rate sensitivity, but it's also hard to get out of these AI plays.
That's me. It's. I think you want to own both of them.
Yeah, right. That barbell.
That Oracle move was just astonishing for that kind of market cap, and that's why you want to be
good for the market.
Yeah, diversified, right?
So we'll skip the tariff thing. Supreme Court is going to hear the tariff discussion after it was deemed illegal, but I won't bring that up because I know Keith probably doesn't want to talk about it. So I'm going to introduce a new segment, and this doesn't always have to be about stocks, but since it's the debut of it, calling it the Watchlist, we're gonna give the people what they want, and we're gonna pick some of our favorite stocks right now. So, and it is the Pickers Market podcast. So, and I feel like haven't done a lot of stock picking lately.
No,
so we might as
just
well
a few.
We might as well pick something. So who do I want to start with? Lisa?
There you go.
We'll start with Lisa.
Okay, let's go.
What stock or stocks are on your watch list right now?
So I brought one, which is MTU Aero Engines, MTU AY. It's an ADR. It's an international company based in Germany. They are the world leader in MRO, which is maintenance and repair, when it comes to commercial engines and military aircraft engines, but also produce new engines, both commercial and military. And when we think I bought it in May. I'm up 14% since then. And I mean, I have it on my watch list for years, and I owned it back when I lived in Austria, and then I had to sell it for tax reasons. Anyways, it was a good point at that time. But now I'm back in, and but I'm following it for a couple of years now. And I like it because when we think of new kind of defense spending in Europe, especially Germany picking up and all of that, and we hear about, Rolls-Royce, Safran, all of BAE Systems and all of that, typical defense companies that are not cheap, first of all, and kind of got all the love. And that's more a little bit of a different play on it, right?
Mhm.
Because it also feeds into military. It is the leader when it comes to military engines there, and also when it comes to the aftermarket stuff. But it's not like a pure play. So valuations are cheaper than the big defense names. I think it's a good long-term play. Little weakness lately, but I think that's a buying opportunity I probably would add here. Yeah, that's my
Nice.
pick
like
in
it.
my portfolio. And
International.
I like it.
Of course she does. Kyle?
I've got a couple on the watch list. A little growthy, which
Really?
is counter to my
Wait, stop the show.
Standard investment. So TMC, the metals company, it's a very small, not well-known company. They basically do underwater deep sea nodule mining for rare earth metals. So there's a lot of controversy around the names where you are basically dredging the bottom of the ocean, and that's what used to happen. And people don't like that for obvious reasons. And now with technology and robotics and all the other good stuff that goes along with it, they can take a much more clean and refined approach to collecting these basically rocks that are at the bottom of the ocean, and then refine those into critical elements that are needed to make your phone, your laptop, electric vehicles, grid infrastructure, all that kind of stuff. So they're the only pure play company in the US market that actually has access to rare earth minerals. All the other companies are basically located in China. So
how does that work in the international waters? They can do that anywhere? Do you know?
They can do it
Just out of
anywhere,
curiosity.
but where they currently operate is basically within the AZID zone so basically the US 200 nautical miles off the Pacific coast. So it's all there. Yeah, it's kind of in the US exclusive economic zones.
Do they have to get permits? Who do they go?
They do have to get permits. So during the Biden administration, they were pretty much on the naughty list of not being able to get access because of environmental concerns and kind of this view of what was the old way of operating. Now they, the regime has kind of changed, and people are kind of a little bit more flexible in providing access to that stuff. So still early days, small company, but some of those pure play kind of single points of failure companies where it's like, you don't really think of access to certain things, whether it be, like uranium or, salt monopolies or things like that. There's a bunch of kind of odd, single source locations globally where things, if it goes down, it's a problem. And you can play that, with typically smaller micro cap names.
Interesting. Those are two different names I wouldn't expect. I'll keep it simple. We kind of touched on it earlier with the interest rates coming down. I think that's a good backdrop for a lot of names that, Kyle kind of follows with, housing and things like that. So the name that's kind of I own in one of the portfolios, I think it's a good go-to name is Lowe's, Home Depot or Lowe's. You can pick your poison there. I think it's either or. I think that's a great, interest rate play. Rates are coming down. People are still working. Now, a caveat that with just like some of these other small cap names is there's a fine point of, renovating when interest rates coming down cheaper and you'll be able to move and all this different things. The economy gets worse too quickly. I mean, you stop all those things immediately, right? You stop. That's where when bad news becomes bad news. I think right now we're in the good news or bad news is good news, which is good for interest rate sensitive plays. And the way I like to play it is Lowe's. That's a very well diversified name.
Like it.
Yeah. How about you?
I'm gonna switch it up a little bit just because I always go with Broadcom. It's still my, still my all-time favorite.
I figured that would be the show of the day.
But I'm actually gonna be kind of like Kyle. I'm gonna go the different direction, a little bit different than what I typically pick on the growth side for my own personal stuff. But JM Smucker is my recent
You
one.
just love that
love
stock.
that stock right
Crustable.
now.
You can tell he's got little kids.
He's got
Yeah.
one in his pocket
The
right
whole
now.
fridge is full with that.
So JM Smucker is the Uncrustable company. They also
I never had an Uncrustable.
What?
No. Is
So
it like? Is it?
good.
Was
New
it?
customer potential.
Well,
for
is
you.
it-
Hold on. What is the Uncrustable of choice
I mean,
in the Ellegard household?
I mean, either or.
Eh.
But what I do know is if you buy the big packs from Costco,
Yeah,
they're more full than if you buy them from Target.
that's true.
Interesting.
But the flavors, there's
Yeah,
quite
what's
a
the
few of
flavor?
them.
There's
What
quite a
is it?
few, but so it's either the grape or the strawberry.
Okay.
I mean,
no
the
Nutella,
Nutella's-
honey and peanut butter,
Wow,
I'm not a-
mixed
I'm not a-
berry.
honey peanut butter guy.
Okay,
The
all right.
Nutella one's fine.
Yeah,
But,
my kids are all about the Nutella one.
but Uncrustables is I mean, that's their growth driver. They've got pricing power there. I mean, you have little kids. I have little kids. You stop buying them. That's no chance,
Mm-hmm.
right?
Mm-hmm.
They're big in the NFL. NFL eats, I think it's at least 80,000 of them per year
Oh, what?
minimum.
Really?
Yeah.
Oh.
But they also have Hostess. So if you know all of your donut goodies and whatnot, and then coffee, I think is the big driver for them going forward. It's been a headwind just with coffee prices.
Oh, there you go, Lisa. At least now Lisa's
now
a
I'm
little more
in.
interested.
Mhm.
So they own like Folgers. They do the Dunkin' at home, like in the grocery store. They do the Dunkin' brand.
Nice.
But coffee prices have been through the roof lately, so I think their margins will normalize at some point here, which will be a good thing for them. So Kyle is a value guy and went growth. I'm a more growthy guy and I go value. So
Mhm.
Strange times.
yeah,
Mhm.
we'll leave it at that. So if you like what we're doing, like and subscribe, and I guess we'll see you guys next week for episode 73.